Hey, do you want to see a strategy of how I buy stocks at a lower, safer price, plus get paid to buy these stocks at that price? I'm going to show you coming up. Before we do that, check out in the link description below if you're interested in this strategy and you want to go deeper. Let's jump in. I went to a site and did a search for options wheel and came to this page. How to generate income with the options wheel strategy. If you haven't heard about it, don't worry. Not many people have, but this is a legit strategy that I have been using for many years now, and it works like a charm. And I'm just going to show you, it's called the wheel strategy because it looks like a wheel. Essentially, what you're doing is you're buying the stock that you want to buy at a lower price. You're getting paid to wait. So this is how it works. Options, there are puts and there are calls. First, you're going to sell the put options. When you sell it, the buyer pays you money. Say the stock price is $100 and you want to buy it cheaper. Let's say you want to buy it at $90. You don't want to pay $100. So you sell a $90 put option and the buyer will pay you money. Okay, because you're selling something and the buyer's paying you for it. You keep that money right away. If the price hits your $90, if it goes below $90, then you're able to buy the stock at $90. So you get in at a cheaper price. Once you own the stock, then you can move to the next part of the wheel, which is to sell a call. So you're selling a put in the first round, and then once you have the stock, you're also a seller. You're selling a call. And when you're selling a call, you're going to sell at a price that is higher than the current stock price. So say the stock price, you bought it at 90, then it goes back up to $100. And this time you want to sell a call at $110. You sell it at 110 and you get money, right? Because you're selling and the buyer will pay you money. And again, you're getting paid to wait for the price to go up to 110. And if the price is over 110, then you sell your stock at $110 and then your stock is gone. And then you just repeat, you rinse and repeat this whole cycle again. And this is called the options wheel strategy. And this is exactly what I did. And I'm just going to show you what I did. Utilize the same strategy this past week, the start of this month in December. And here we go. Here's my fancy chart. All right. So in December 3rd, Wednesday, December 3rd, I had sold my UPS stocks, made a pretty good profit at $98. The stock went down. So the next day, December 4th, I sold two put options at the $95 strike price. All right. So when the stock, I had sold it at 98 and then it went down a little bit. And I decided I wanted to get back in this great stock at $95 below the current market price. I sold it at 49 cents. That's the premium. Okay. 49 cents. You always multiply it by 100, and that's the payout. That's the money that they give you. The buyer pays for your time. So I made $49 times two, which came out to roughly about $100. So they paid me $100, and that went instantly into my cash account, and I kept it. Now, what was really cool was on Thursday, December 4th, I received a $328 dividend. So every quarter, UPS will pay, the stock is UPS, they pay a quarterly dividend. So that went into my account. And so basically, I had sold my stock, then I sold two puts, and we started the options wheel strategy right here at this point. Options have expiration dates, and the option that I had sold were weekly options. they expire after a week. And on Friday, the UPS closing price fell below 95, which means I have to buy 200 shares at $95 each. So Monday, I was assigned 200 shares at the strike price of $95. We're here. I sold the puts. I bought the stock on Monday. And then on the same day, I decided to sell calls. And you can see here, same day on Monday, I sold a $93 call at $2.66. Now, there's a reason why I picked $93 because we have a little bit of market uncertainty. We have, I think the broader markets are a little bit overpriced, and in the short term, they're going to pull back. And so I wanted to capture a little bit of profit if my stock price goes down. So I had sold two calls, $2.66, which means I got paid $266 times two. But since I picked a lower strike price at 93, right? I have $93 means I have to sell it at 93, but I bought it at 95, which means I'm taking a $2 loss. So that's a -2, but I'm getting $2.66 in profit. So the net is 66 cents per share, and I have 200 shares. So if you do the math, I get paid a net of $132. And you can see I sold a call. So we're at 1, 2, 3. We're on the third part of the wheel. The call options expire this Friday, and depending where UPS closes on Friday, if it's under $93, then I keep all of $2.66. That's pure profit. If it's over, then I will be forced to sell my shares of UPS at $93. And that's okay because I can just go back and sell more puts to buy it at a lower price. And there you go. That is the wheel strategy. And if we look at my returns, the profit I made from the two options that I had sold, 100 plus 132, plus a dividend, 328, that comes out to $550. If you would like to know more about this strategy, check out the link in the description below. You can find out and go deeper and understand how this works step by step. Thank you for watching, and I will see you in the next video.